Hi everyone, my name is Grace Stolberg. I'm a financial advisor here at O'Keefe Stevens Advisory, and today I'm going to be walking you through our financial planning process. So at O'Keefe Stevens, we're always starting with financial planning because it's what allows our team to get fully up to speed with you and your unique situation before we provide any advice. Before we get into the financial plan itself, I want to show you an example of a proposal. So this would be what you'd receive if you had gone through our discovery call. We'd both gotten to know each other and decided it was a good fit. So we send you this proposal. In this example, it's for Tom and Judy retirees. So I'll give you a little background on them before we get into the plan. So we include the discovery notes right in the proposal. So Tom and Judy are 63 and 64. Judy has already retired. Tom is getting ready to retire in the next year or two. They've done a really great job of saving and living within their means over their careers. They've amassed roughly 4.6 million across their retirement accounts and have a few other accounts like an HSA and a brokerage account. They own their home, are paying off a mortgage, potentially would like to add a second home to the picture in the near future. And they really just want to work with an advisor to make sure they're doing all the right things with their money. So here is our schedule that we included for Tom and Judy. The total price for this plan was quoted as $1,500, but one important feature of our plan is that it's an incremental process. So the first half of the quoted fee is paid up front, and only upon the full completion and satisfaction of you as the client would the second half be paid. Most times, though, our clients never have paid the second fee because they choose to implement our recommendations with our team after the planning work is done. Also, I want to point out our money back guarantee. So, like I said, the second half of that financial planning fee would only be paid if you are fully satisfied with the work that we've done for you and your family. If for some reason you're not satisfied and you say that was a total waste of my time, we would fully refund any fees that you had already paid, no questions asked. Once you've had a chance to review the proposal, ask us any questions and are ready to move forward, we would get into the financial plan. So we're going to switch gears over to the plan itself. So here is Tom and Judy retirees financial review. You'll notice that this is an Excel file. So all of our financial planning is done purely in Excel. And that's just because we found it's what our clients are the most comfortable and familiar with. People would come to us with Excel files of their own for budgets or account tracking. So we figured why not work in grounds that you're the most comfortable with. So the first two pages of the plan, the net worth and income statement, are really just the building blocks for the rest of the plan. So no real analysis is done in these first two pages. It's just for us to update in the beginning of our financial planning and then in every review meeting afterwards to make sure everything is being accurately reflected. So in the net worth statement, we'll have all your assets and liabilities. Assets include things like bank accounts, the split between checking and savings, health savings account, flexible savings account, any brokerage accounts, IRAs, 401ks, 403bs, really any retirement assets. And then we have real estate assets. So your home, if you have multiple homes, we'll list those here. You have business property, that would also be included. Then we'll include any liabilities, so things like a mortgage, car loan, student loan, home equity line of credit, whatever your situation is, that'll be reflected on this cohesive net worth statement. Tom and Judy's total net worth is 5.4 million. So as long as that was accurate, we'd move on to the income statement. The income statement shows current income streams in the top section. So while Tom is still working, we have his salary reflected. Judy will claim Social Security this year, so we will reflect that benefit. And then she'll also be withdrawing from her IRA. So we include that distribution. This lower section, income not being taken yet, like it suggests, shows all streams of income that have yet to be tapped into. So Tom, we're showing his Social Security benefit at full retirement age. And then the rest of these are their investment accounts, and we're assuming a 2% withdrawal rate from the current value. Moving on to the beginning of the analysis work is the financial benchmarks page. This is based off the CFP board's 3-panel analysis. So we're looking at a broad category of risk management, then short-term savings and investing goals, and long-term savings and investing goals. So within each of these categories, there's subcategories where we're looking for a specific metric that's recommended by the CFP board. We'll show your current status for each item, and then if we have any comment or recommendation for improvement, that'll be in this column. So we'll go through each of your insurance policies, make sure your coverage is appropriate if you need that type of coverage. We don't sell any insurance here at O'Keefe Stevens, but if you have a need, we want to make sure that that's being met. Short-term savings and investing goals, same type of thing. We will go through each subcategory like emergency fund and make sure you have an appropriate amount of funds set aside in the bank account given your spending. Long-term saving includes things like your retirement savings percentage, if you're planning for college education, whether that's for kids, grandkids, yourselves, that'll be listed here. Lump sum goals, for example, Tom and Judy wanted to eventually buy a second home. So we discussed plans for that purchase and different ways for them to finance this purchase. Legacy goals are a very important part of this page specifically. No matter what your age is, if you're married, have kids, no matter what the situation is, we want to make sure you have appropriate estate planning done. So whether that's something we're helping you with or if we're referring you to an attorney for more complex situations, is definitely something we'll review. This last little piece is something we added because people were always asking us how they're doing in relation to people their age. So it's a benchmark of your investment assets to your gross pay by your age group. So you can see in this example, Tom and Judy did an exceptional job of saving and are well past the benchmark for their age group. This next page is our retirement analysis. This is a highly interactive tool that we encourage you to kind of play around with, change some of the factors to see how it affects the outcome. The outcome being this interest rate needed. So this calculator essentially takes into account all your current facts, like your income, what you're saving, what your taxes are, what you spend as a household, and how those will inflate over the next years till your retirement. And takes your current total retirement assets and finds the interest rate that you need to achieve over your time frame to have a fully funded retirement. So this is a great tool. You can adjust all these little icons to see how it impacts the rate of return needed. Ideally, we want to see this number around or below 8%. You can see Tom and Judy have a negative 38%, meaning they've done, again, an exceptional job of saving and are very overfunded for retirement. This next page is where the bulk of our planning is done. These are our 30-year retirement income projections. So we're showing year by year over the next 30 years how your assets are all growing given a conservative growth rate, what your income sources are each year and how each of those sources are taxed, any retirement and savings contributions, and then expenses. We have total household expenses like bills, groceries, mortgage payments are included in this item. We inflate that 3% each year. Your federal taxes and state taxes, if applicable, are calculated below year by year based on most current tax brackets. And then Medicare premiums, healthcare expenses, those are a big part of the plan and a big item normally planned for in retirement, so we include those as well. And then we have a final surplus or deficit each year. The projections in particular are very helpful for planning, specifically for our clients, because a lot of them have done an exceptional job of saving for retirement, like Tom and Judy. So they each have done a great job of saving and living within their means, and therefore have large balances in these tax-deferred accounts. When they reach RMD age, though, at age 75, they'll have to take out a significant amount of money from each of their IRAs, well into the hundreds of thousands, almost 200,000 for Tom. And these RMDs are calculated based on their factor, which is linked to their age. So you can see once their RMDs start, total household income jumps up significantly, and so does their tax bill. It more than doubles each year once their RMDs begin. This creates a significant tax problem over the rest of Tom and Judy's lives, and we're projecting that over these 30 years, they would have paid over $4 million in taxes, just federal taxes, not even state taxes. So a lot of the planning work that we do is around identifying how can we minimize your lifetime tax bill. So through this, we can do a Roth conversion analysis. So it's the same exact situation as this baseline projections, just with the addition of Roth conversions. Because we have this handy tax calculator, we can identify just how much more income you can recognize in a year through Roth conversions to not push you up into the next higher tax bracket. So for Tom and Judy, we showed them doing Roth conversions up to the top of the 22% tax bracket from 2026 until 2035, the year before their RMDs begin. By converting up to the 22% bracket each year, they convert a total of 759,000 from their traditional rollover IRAs to their Roth IRAs. And we're projecting that this would save them roughly 625,000 in federal taxes over those 30 years. That's due to the fact that we minimized the balance that's held in their tax deferred accounts and shifted it into a tax-free account. Therefore, their RMDs are lowered and their taxes lowered. So not only can we do Roth conversion analysis, but we can model scenarios like buying a second home and exploring different ways to cover that purchase. We can add in business succession planning, gifting strategies, charitable giving. Whatever your unique situation entails, we can add this into the projections so you can see the long-term impacts of making different financial decisions. One more thing to add before we wrap this up, we can add in a few different types of analysis based on your unique needs. So if Social Security timing of benefits is a concern for you, we can show the impact of claiming at different ages and show the difference in income received over the next 10, 20, 30 years. We can do pension analysis to show the impact of annuitizing a stream of income versus taking a lump sum benefit. Do educational planning to ensure you're contributing enough towards your child's education to reach a certain goal. So the fact that our planning is all done in Excel gives us a lot of freedom to create different types of analysis tools to make sure you're making decisions with confidence. I hope this has been helpful in showing you what to expect when going through financial planning with O'Keefe Stevens Advisory. Thank you for watching this video, and we look forward to working with you on a plan of your own soon.